Hello and welcome everyone for today's show on Latoken VCTV. Today we have a very interesting topic on. Hello, sorry, am I audible? Okay, so hello and welcome everyone for today's show on Latoken VCTV. We have a very interesting topic today on Latoken VCTV. We'll be talking about global investment scenario and focus of venture capitalists. What do venture capital firms and VC investors look for when they try to invest in a startup? And what are the key difference between a traditional business, a bootstrapped business, and a VC-backed business? What is an angel investor and what is a vanilla-based a plain investor? And we will be talking more on this scenario. So by the end of this today's show, you will be having a clear-cut idea of how VC funds work. With me today, we have Tushar Kansal from India, who is our panel member. So, Tushar, a brief introduction about you and the work you have done so far.
Thank you, Amit. Myself, Tushar Kansal of Kansaltancy Ventures. We are a global investment management firm assisting investments into tech and non-tech companies. I have personal corporate experience in private equity practice at Deloitte and Touche, also Brand Capital, which is India's largest VC fund by the number of deals. Was part of the team there, which invested $100 million. Also was heading treasury at MTS India, where I raised $2.5 billion for the company. It is an India unit of Russian conglomerate Systema, and was CFO with the Distribution Logistics. That's a company owned by Guggenheim Partners. In the last 7 years, managing Consultancy Ventures, I have personal investments in 4 companies, and we guide a lot of founders of startups and growth stage companies in a number of ways, and mostly by facilitating investments in their companies. Nice to be here, Amit.
Thank you, Tushar. So let's begin today's topic. So basically, Tushar, I had one starting question in my mind. So what is the basic difference between an angel investor and a normal investor? Why the word angel has come to certain type of investors?
So, if you are an investor, you have many options to choose from, right? If you are living in a Western country, you can't really put your money in the bank to get a return, because the rate of returns on a fixed deposit in a bank in the Western country is 0.5%, 0.25% per year, which is hardly anything. In emerging economies like India, the returns are 4% post-tax, 4.5% post-tax, which is also actually nothing. Then, an investor has to choose between investing in mutual funds, stock markets or listed companies, where the risk profile is less, but the returns are a little bit more. So you can expect 7, 8%, 10% return. And in case of some good stock market movements, you can expect a better return. Now, the thing is that how does an investor make money? So he has to choose basis the returns available across asset classes, and he also has to see the risk profile. What is the risk inherent in an investment? So what happened was that the US dollar is the reserve currency globally. So it is used for global trade. Because of that, the demand for dollar is always very high. And because of that, the US has a liberty to print as many dollars as it wants, and still the value of the dollar doesn't fall down too much. So it runs huge deficits in its budgets and spends more than what it can meet. But this is not the same for other countries. They can't print currency and just spend it, because if they print too much currency, there will be a lot of inflation, and because of inflation, the value of their currency will go down. Just like Zimbabwe printed a lot of their currency and the value became zero. So you asked about angel investor and a regular investor. The whole background of what I'm saying is because an angel investor is someone who says that okay, I will invest in unlisted starting up companies, startups. So these are very risky asset classes because you don't have much on the ground. Like you can have probably a technology product. You can have some founders who have done some good education, and you can have some sector knowledge. But end of the day, because the equity the in which you will put money is unlisted, you can't really sell it anytime. Because of that, the risk is high, and hence the word angel, because angel is someone who's helping out like an angel, helping out startup founders by giving them money when hardly much is there to show, and a lot of the plans and project is actually on paper, and he's taking a risk which is more than if he invests in other safer asset classes. That is why angel investor versus a normal investor.
Great, great, Tushar. You just told the ABC of the investment, which was a really nice start. The next question I would like to ask is, I mean, this is a basic question that rise from curiosity of my mind. So, where do the VCs get all this money from? Do they get it from their own, or do they borrow it from somewhere and then put it on a startup? What kind of scenario happens in this case? Also, another question is, what is the difference between various types of fund provided to the startups?
Okay. Uh, so, because the currencies of the Western countries are strong, and because their economies are larger, and historically they grew much faster, so their economies are larger. And what happened was that a lot of their manufacturing and uh, uh, environment damaging industries and labor intensive industries, they all moved out from Western countries to emerging economies like China, India, Vietnam, Bangladesh, and so on. Because so a large part of their GDP is actually services. So they are actually making money by managing money. And because dollar is the reserve currency and a euro was an experiment by European economies to create a strong currency which can fight out with the dollar. That is why their service sector, financial services sector, and the tech sector both are well funded and very strong. Now, who are the investors in the VC funds? Now, if any large financial institution like a bank, like American Express or any Spanish bank, or they want to make a return. So, apart from their usual business, which is lending, giving out loans to uh, to retail clients, giving out loans to corporates. Apart from that, they have a lot of money lying in their treasury to earn from treasury operations, which means that whatever cash is with them, they will use it to earn money. So if they are using that cash to earn money, then the whole thing is that it has to be invested somewhere. So either it goes into stocks, it goes into commodities, it goes into gold, it goes into real estate, it goes into commercial real estate, and now it goes into Bitcoin, Ethereum. So all that money which is sloshing around the global financial system, to give you a sense of it, $12 trillion were printed, rather $15 trillion were printed, currency was printed by the Western countries in a matter of 1 year. And, the things have been such since 2008 that the global economy is going on just by use of printing of currency. and the returns which are generated on that currency are becoming smaller and smaller. So each unit of currency which goes into this economy produces less and lesser returns. So the currency is so much, their financial sector is huge, they need returns. And when they need returns, they chase the riskiest of assets. So the riskiest of assets would mean anything. And in the present scenario, it means VC funds who invest in unlisted idea stage, pre-series, seed, Series A startups. And so if you look at the limited partners of VC funds, you will find two types of investors in these funds. One are the high net worth individuals, the wealthy class, who want to make a return, and they see examples like the Sequoia's fund, which had invested in WhatsApp. It got a return of $19 billion, that particular fund. So you can imagine the investors in the fund who had invested some couple of millions or 10 million would have made billions. So that's why, because of the portfolio approach of these VCs and exponential returns on few of their investments, all of these pension funds, banks, all these financial institutions, they are putting money in VC funds. The second is the high net worth individuals like conservative, old time families, and the new families who have their own family offices. They are chasing returns, and hence they put money in VC funds, which are led by general partners who are experienced from a good background and who know the sector and who know investing as a discipline. What was your second question? I'm sorry.
The second question was, what is the difference between various types of funds provided to the startup? For example, it can be VC funds, grants, or crowdsourcing. So, what are these kind of funds, and what are the basic differences between these?
So the various type of funds can be bridge financing. Now, what is bridge financing? Suppose a particular startup wants to raise funds in 1 year, but it finds that it is running out of cash earlier. So instead of raising a full round now, it will raise a bridge financing, which is high interest rate financing, high ROI financing of a tenor of less than 1 year. So what will happen is that they will give their shares as collateral to an investor and raise bridge financing. If it is a bank, it's a corporate who needs a loan, a bridge loan, then they would also give some collateral and take a high interest bridge loan. The other is there is seed stage financing, which is the financing which is pre-revenue, and then there is pre-series A, series A, series B, series C. Those depends on the stage of the company. And in terms of tenor, usually a VC fund invests for 5 years, but the investors who are very patient, like the European investors, they even wait for 8 years. In the in the context of some conservative business families, they like to get their money back in 3 years. So that is as far as tenor is concerned.
Great, Tushar. So, next question is, what is a valuation of a company or a startup? What is the valuation, and how do the VCs evaluate it, and how do they calculate it, and what are the factors that they look into when they try to invest in a company?
So VC, see, the if the investment is early stage, the more early stage it is, uh, the bet
More
of the
riskier.
VC is it's more riskier. So he's essentially betting on the founders that this is my horse, he will do the job. And if there is minimum viable product, there is product market fit, there is first is scope of proof of concept, then is minimum viable product, then is product market fit. So these are ways which we define whether the pricing, the structure, the distribution strategy, and everything of a particular product or service has been finalized and in tune with a particular market. So those are the stages at which the VC invests. Uh, what was your other question? I'm sorry.
So how? Yeah, the basic question was what is the
The VC
valuation of a
valuation.
startup, and how do we calculate it?
Now, how do you value a startup? If it is pre-revenue, then a lot of investors, instead of relying on a formula because there is no revenue, how will you put a formula? They do a convertible preference share or a convertible debenture, and the valuation at which that preference share will get converted into equity is at a future date,
Future.
and
Okay.
that valuation is linked to the financial performance of the company at a future date. So suppose the company does 1 crore turnover in 1 year, 100 $500,000 suppose, then we can say that 5 times the revenue will be the valuation of the company after 1 year. So at that valuation the preference share gets converted into equity. And in case we already have revenue, then there are 4 or 5 ways in which we value the company. I'll define it very in simple terms. One is market multiple. Now, you will have companies similar to yours listed on the stock exchange. So you pick 2 or 3 of those companies, you see what is the market capitalization of that company on the stock exchange, and compare it to the financial performance of that company. So you will get certain ratios, market cap to sales, EV to EBITDA, and so on, price to book, and price to profit. So a PE multiple. So all that ratios you put on your own company. So you will arrive at the valuation of the company. Secondly, transaction multiples. You look at those companies which are similar to yours and who have recently got funding in the last 6 months or 1 year. You can get access to their financial performance from the corporate company law website. So you can get those ratios again, the valuation of the company divided by sales, the enterprise value of the company divided by operating profit, and you use those ratios on your own company. Now, whenever we are using market multiples, which is the stock market comparison, we have to keep in mind that these companies are huge, which are listed on the stock exchange, and they have a successful history. So we have to discount the ratios to some extent because of uh, business dynamics, size, and so on. The third factor is net asset value. For real estate companies, for financial services companies, their real value is the assets they have. So a real estate company will have a land bank, will have constructed real estate on which it is generating lease rentals and other rentals. And in a financial services company, will have a loan book which is generating a return. So that is an asset. So we use net asset value in those cases. And for companies which which mostly will deliver value in the future, we use discounted cash flows. So it's very simple. We make a 5-year projection of the company, what operating profit and what cash flows it will generate in the next 5 years, and we uh, derive the current value of the company by bringing the value of those cash flows to the current date, to today, by using a factor which is called cost of capital. So these are the ways in which valuation is done. But for all practical purposes, a company which is pre-revenue, one usually goes in for a convertible preference share, which is whose valuation depends on the future, either on the future financial performance of the company, or uh, any next round of funding which happens, at what valuation that happens. So a discount to that, because the investor is investing right now. So I hope I've answered your answer correctly, your
Yes,
question
Tushar.
correctly.
Tushar, yes. So, Tushar, one more question is, most of these startups that are emerging today are not yet profitable. For example, Tesla, or for example, Amazon. Just Amazon got its profit after nearly after more than 10 years. But VCs are just pouring in investment. VCs are just pouring in money. So how do the VCs manage these kind of investments, and what is the prime criteria that they see while making this kind of investment? Because there is no profit that will come in the next 5 years. So how do you manage this kind of situations?
So how do you calculate your return? You make an investment, right? One is you are getting a regular return on that. Like, if you are giving a loan to somebody, you are getting an interest. If you are buying equity, then the company issues dividends. So you have some regular income. But the other aspect of that investment is that what you have bought, the value of that increases. So, you bought a share for dividends, but the value of that share is increasing. So that is also a return. You buy a real estate, it gives you some rentals, but the price of the real estate also increases. So what is happening is, because of this $15 trillion money printing, because of the fact that lockdown and COVID are there, because people are sitting at home, and people have access to the best technology like the Robinhood app in the US, and in India, you have these apps. So it is, it's like poker. You are actually betting on stocks, and because so many people are betting so much of money, so the value of the share is going up. Now the value of the share goes up so much that it gets delinked from its underlying fundamentals. And what the research analysts and what the market researchers, they do all the days, they try and figure out, why did the stock rise, why did the stock fall. So stocks have their own momentum. I mean, we are talking about Tesla, which made the first profit in its history, and its value is $900 billion, which is more than the combined value of all other automakers. So it does not make sense, right? I mean, you have 40% rise in Amazon's turnover, and its value goes from 1 trillion to 2 trillion. So people are essentially saying that technology has gone deep into our homes and our offices. We have a monopoly situation with Amazon, where anybody wanting to be a part of e-commerce business cannot ignore Amazon. So people are saying that 40% growth in turnover in 1 year means that this company is actually on its way to even grow further. And because they can see the tech situation, they can see the monopoly kind of situation. So they feel that it's a risk-free investment. Just go all out and buy Amazon. Just go all out and buy Tesla. And that is what is happening. I mean, essentially, it's a roller coaster, and because so much of money, retail money, institutional money, is sloshing around in the system, it is chasing asset classes, and uh, the easier it is to invest in a particular asset class, the more easier it is to for that asset class to be on fire and grow in value. So uh, especially with these new age stocks like Tesla, like Facebook, Amazon, Netflix, Google. The fact also, not so much Tesla, but the other ones which are called FANGs. The fact also is that they hold tremendous amount of data about the global population. So in between all of them, or rather even individually, they have access to 5 billion people's data out of 6 billion. And so these 5 billion, uh, Google has mapped them on 700 parameters. So they understand you and me better than we do ourselves. So because they have so much of data, they do targeted advertising. Because they are doing targeted advertising, hence traditional advertising people are not preferring, because the returns on targeted advertising is more. And because that return is more, we see the turnover of Facebook at 80 billion or 75 billion dollars, Google hundreds of billions of dollars. Now, if we have such kind of monopolies, which are global monopolies, their stocks are on fire. And so that is the way things are panning out as of now.
Great, Tushar. Uh, Also, some of the companies have not yet made profit, but yet investors are pouring in money because they want to see the startup to capture the market first, to be in the growth phase and capture the wide area of the market first, and then they see that okay, we can make profits later, just like Amazon did after 10 years. So after 2014, it started making profits. So do all the startups that are present follow the same kind of rule, same kind of uh, technique? First grow yourself and then make profit, or is it sector wise? Some of the sectors wants to do that kind of thing. What is your view on this?
Thank you, Amit, for a very good question. I mean, this question holds relevance wherever we have equity investing: losses versus returns. So, as I told you, either you look at the interest rate or dividend kind of return on an asset, or you predict that the value of the asset itself will increase. We have to critically understand why the losses are. So, now in India, we had Flipkart, which came up. We had Big Basket, Grofers. Then we had Zomato and Swiggy, and all these companies were guzzling cash. They were utilizing huge amount of money of the investor, and they were in losses. So what happened was, because they were totally wanting to capture market share, hence, within very few years, 3 or 4 years, they became the top three companies in India in their sector. So once that situation happens, instead of a bottom up kind of valuation, they start getting top down kind of valuation, which means what is the Chinese market size? How, these top three players are holding this much revenue, so their valuation is this much. Now you compare the top down thing to India. This is the market size, so this company should be valued this much. So, because it goes away from the ground level fundamentals and rather linked to the top down valuation, so things start looking differently. Now, when I said, why are there losses? To all credit to Jeff Bezos, he started out with the e-retail company of books at the time when internet had started. Then he got huge amount of money from dot-com boom. I think he raised $100 million when he was nothing. To all his credit, all throughout these 26 years, 27 years, we have seen Amazon. He kept on plowing that money back into investments, back into creating warehouses, capturing new markets, entering new segments, making his technology more relevant. And people used to tell him that, why are you always making losses? So he said, my losses are because I'm investing whatever money I earn. And because I'm investing whatever money I earn for growth and market share, my future value will always be high. And look at what he has created. Uh, we have Starlink project. I think Starlink is Amazon
Tesla.
only. Uh, Sorry.
Tesla. Starlink is Tesla.
Oh, Starlink is Tesla. So Amazon also has a space project.
Space.
I think it's Cooper. Forgetting the name. Then he created Amazon Web Services, which is in itself billions of dollars. I mean, AWS today is a very profitable company, and Also, in itself, its revenue is in multiples of billions of dollars. So not only did he ensure that his company became a monopoly, and many of the people point out to some of the negative side effects of that as well, but he also ensured that he created new offshoots. Now, if you are an investor, Amit, will you like that a company in which you put money in 95, 94 today is the largest company on the globe, across countries, also has a very profitable cloud division, which is even 50, $70 billion. It also has a space project, and it has so many offshoots to its business that it is present everywhere. Now, as an investor, will you like that, or will you say that, oh, this company is making losses, I don't like the losses? And the thing is, everybody is holding those dollars which are being printed. So if you don't put in the money, somebody else will put in the money, because
Correct.
everybody is chasing returns on assets. So that is the situation.
Great. Great, Tushar. Thanks for that. So, in India, we have emerging, not only in India, all over the world, this COVID has sparked a great revolution, is going to spark a great revolution in health tech, specifically with healthcare technology and mixing it with deep tech like AI, ML, artificial intelligence, and machine learning. So, what kind of use case do you see in this kind of investments like pharma tech or healthcare tech side of investments?
So, I'm recently advising a pharma-tech company. Now, if you look at all the technology which goes into a pharma-tech company, it is mostly internet related. So you can have an app, you can have a website, you can have a number of AI-based innovations. But there was a Cap Gemini study which happened recently, which 79% of Indians polled there said that they would like to see more in-store automation, and 85% of Chinese said that they would like to see more in-store automation. So things are also developing on the lines of in-store automation, like visual reality, virtual reality, and augmented reality. So a lot of warehouses of Amazon and other companies, they use robots, and especially in a pharma, there are so many branded brands of medicines. Every medicine has five or six companies chasing it with their own brand. It is very difficult for a retail guy to get a medicine fast out to the counter. So, this pharma tech company, they have a face recognition technology. So, a person enters their retail store, uh, they automatically identify who this person is, what is his history, family history of his health issues, um, when did he visit last, what medicines he took, where does he stay. Then they are able to also point out that what the what is the upskilling and upselling and cross selling we can do to this customer. So if he has if he's buying a medicine for a bone related issue or a back related issue, they can refer him to a yoga therapist, near his home, and also earn a commission from that. And so whatever he buys is through a fintech app, and his receipt gets delivered to him automatically on his mobile. And so the whole record of that particular customer is there in the system itself, and the medicines are fetched by robots. So that kind of efficiency. Now you imagine a neighborhood store trying to compete with such a kind of store, will automatically lose, because customers will grow up, they will get used to this technology, they will get used to being served better, and being served on time, and being served at their home. And this is what happens, survival of the fittest. So my advice to a lot of companies who come to me is, use technology, better get, just like I remember one of the kids was telling me he studies in a convent school. Now, the convent school is not very used to using technology. So, because of COVID, they are using technology. So something was forced to them, which is actually so easy to use for a lot of people. I remember in my investment sector also, a lot of people used to tell me, let us meet up, let us meet up. If it is not required, we can always be on Zoom calls, Google Meets. We can always use technology, and that is what has happened across the board in terms of technology coming into our homes. If you look at the 99.com bust, then 2008 Lehman crisis, and then now COVID, technology has actually marched right inside our homes, and this trend will continue in the future as well. And COVID, now the good part is that the vaccine is out, and so people are not so scared. But it has left a lasting imprint in the way of life of people across the world.
Tushar, so what I understood from your statements were technology is inevitable. So we cannot push the technology behind. Even if we as a bunch of people try to ignore the technology, somebody else will accept the technology, and more business will come from that side, which will again cause a competition to us, and we will lose the competition. So yeah, I understood that technology is inevitable. But one more point I want to ask is, for example, we have a long-standing problem which a technology can solve, but due to government regulations or due to government rules and regulations, we are not able to solve the problem. Even if a startup has a funding, it is not able to solve that problem because of government issues. So what kind of approach or or the startup can actually solve the problem by convincing the government, or what kind of way out is present in these kind of situations, Tushar? I just want to I just want to know your insights based on your experience.
See, the thing is, the government budget, if you talk about, suppose an example can be Indian example, the government budget used to be 75% of the GDP. It became 55%. Then, private sector in 91 and so on started taking over sectors. A lot of productivity started to come out from the private sector. And then now, government budget is just 15% of the GDP. So whatever noise we may make about government interventions, and the fact of the matter is, it's mattering less and less unless it is linked to security, the security aspect, which is a crucial backbone of what a government should do. So unless there is a security related issue, KYC, know your customer issue, uh, money laundering and terror money, if there are those kind of issues, then, but for any technology which is for the benefit of people, it is potentially also used by those against the society, like terrorists and so on. So the government has no option. You can't just say we won't allow this technology because the technology is agnostic to borders. It can only be monitored up to a certain extent. And if you want to stay ahead of the curve, you better learn that technology, adopt that technology, make yourself conversant and in ever more futuristic technology, so you are able to catch those non-state actors. So, I remember Narayan Murthy, who is the founding father of Infosys, India's first global IT company, information technology company. He had to apply for so many licenses to get a telephone connection. I mean, we are talking about 1985 and 86. And he got so tired of that, uh, that it still serves as an anecdote to how things were. But we have long traveled down that path that the government understands technology. Uh, the main thing here is about control. Now, if 5 billion out of 6 billion people in the world have been mapped on 700 parameters by FANGs, by Google, Facebook, and so on, it is a potential loss of control. It is a potential security issue as well. And look at what Chinese have done to address this issue. The Chinese have firewalls on their internet. Instead of allowing FANGs to operate in China, create monopolies there, they created their own companies who have monopolies. So Alibaba, Baidu, WeChat, and so on. And all those data of the Chinese citizens resides in servers in China and in the hand of the Chinese government. So they ensured that any third party cannot influence their citizens without the involvement of the Chinese government. Now, this kind of a thing is not possible in a lot of democracies. This is also because China is a single party country. So they can enforce something which other governments can't. Having said that, look at European countries. A lot of European governments have mandated rules and regulations and laws which ensures that the data of their citizens stays in servers in Europe. And because everybody fears European regulators, everybody fears Chinese regulators, so they can throw their, they can enforce what they want. So a lot of companies also, the penalties of defying their rules and regulations is hefty. They will put a fine of $500 million, $1 billion. So how many companies are in a position to defy those kind of regulations? So they are enforced. And so this has happened in this part of the world as well, because a lot of governments are waking up to the potential outside influence, a chance of a outside influence. So they are now mandating new laws which will ensure that the data of their citizens stays in the country. And just Amit, think of it. Twitter deleted Donald Trump's account when he was a sitting president. In how many countries is that possible? I mean, you talk about Russia, you talk about Europe, you talk about other places like South America, Africa, India. Can you do it? I mean, would you be able to defy your government for that? So it's not really so much possible. And given by the way things are, my prediction is that increasingly, just as global trade has taken a turn towards protectionist instincts and free trade agreements are now out of the window, just like that, even on the basis of data, there will be protectionism. Like Mukesh Ambani, who owns Reliance, which is one of the top 10, 20 companies in the world. He said he's made all his money from oil. And he said in an annual general meeting, AGM, he said data is the new oil. And that is why he created Geo Platforms. And look at the valuation Geo Platforms got. It raised $34 billion from Facebook, Google, from Qualcomm, and you name it, from Saudi sovereign fund and UAE sovereign fund. And so data is very important, and your question is very, very relevant. And definitely there will be more action happening on in different countries in this regard.
Yes, Tushar. The very fact that you mentioned Narayan from Infosys, you mentioned his name. In this regard, is also a great thing because I think one of the pioneers of Indian IT industry is also Nandan Nilekani, who actually is creating such kind of framework. There is a framework called Account Aggregator Framework, where we are the owner of our data, and we actually regulate who uses our data, and so we give the permission of our data. So yes, that was great. Uh, Tushar, one last thing I want to understand from you is what kind of interesting investment themes do you look for from an investor point of view in the recent year, right from 2021?
That's a very, very relevant question, Amit. I feel that consumption will be strong as always because a lot of the countries they had very liberal government dolouts in the time of COVID, and all that money in Canada, US, European countries, Germany, India, China, so all that money will go into consumption because there is not much to be invested from that kind of money. And consumption themes will be strong. Second is technology, specifically health tech, because of COVID. Health tech has come to the front. Agri tech has been very strong in India per se because of the farm laws, and that the whole of India has become a natural competitive agriculture economy and not state controlled. Uh, if you know that ISRO in India is the monopoly player and it is owned by the government. So recently the
Yes,
monopoly of ISRO was taken away. So space tech is very hot, and also because of Indian conglomerates, Airtel's, Bharti's investment into OneWeb, which is creating a whole range, huge constellation of low Earth orbiting satellites, which will provide internet. So on that, we will see a lot of action happening because the same is being done by SpaceX and Kuiper, and so all these are competing to create low Earth orbiting satellite. Whole many of them to provide internet in far flung areas. Food tech will remain strong because we are living in times of lazy economy where husband and wife are both working and they don't want to go out because they're so tired. Salaries are more, so employees are less. So everybody has to do a lot of work. So food tech will remain strong. Also, because food forms the largest component of the expenses of a family in India and in many places. Artificial intelligence and machine learning will continue to be strong because huge data is generated by these tech companies and it has to be crunched and it has to be used to provide pinpointed services to the customers. And deep tech and disruptive tech, and I was working with a very interesting robotics company, and their robots are simply awesome, and that is something which enthused me a lot. Having said that, investors will typically stay away from operationally heavy and cash guzzling businesses, and they would rather focus on core competence, and that you set aside this money for something you do well and just do that well, and have nimble strong, small teams. And also companies which have a lot of know-how of the hyper local factors, and who understand the local markets very well. So to give you an example, in India, cooking by the families is a very common thing, and it is not so much with Japan and Southeast Asia where women are also working, and so they don't have time to. They don't prefer. Even in the US, people eat out a lot, and so any company who knows the local factors they are better positioned to offer a pinpointed service, and so investors will continue to love these kind of companies.
Great, Tushar. It was a very informative session today. Understood the technicalities, understood the future, what kind of future investments will be coming forward, and many more things. Thanks for coming on today's show. Before we close today's show, do you have anything that you want to add uh, from the startup point of view? Like, how do we approach investor? How does a startup approach investors? As your closing remark, please.
So what I do is, when startups approach me, growth stage companies approach me, what I do is I mentor them as to what investor is looking for. Secondly, what kind of document you should have to show it to him. For example, a lot of investors don't want single founder companies, so it's better to have a team. It's better to have a professional board of directors. Similarly, what is the investor looking for while giving you a term sheet? So, what is a term sheet? And how to read a term sheet, how to negotiate a term sheet. Then due diligence, the investor will do a due diligence. So you should know how to save time on that. So I help in that as well. And then negotiating the shareholders agreement. Apart from that, one should know the investment thesis of the investor you are approaching. That is the most critical part, because investors don't have much time. So I am myself an investor, so I can very well understand what time is to an investor. And the investors have a marked preference on their investment thesis, because they raise their money from limited partners, from LPs, by selling them the investment thesis. That so they have to adhere to it. And so it's always good to see the website of the investors before approaching them, and I help in that as well. So my main role is not only investing. I help 38 high net worth individuals put in their money. I have relationships with more than 600 global investors, family offices, angel investors, and it has been a amazing journey since the last 7 years in the space. And I welcome all of you listening here to join me on LinkedIn, Tushar Kansal, Consultancy Ventures. It's my name written there. And I most feel free to approach me on LinkedIn. And thank you, Amit, for a brilliant show today. And as usual, amazing moderation.
Thank you, Tushar. If in future I get an idea or I get a startup idea, I'll definitely try to come to you to
Sure,
get your advice.
most welcome.
All right. Thank you, Tushar, for connecting today's show. Next show, we'll be looking forward to connect with you again.
Thank you, Amit. Thank you so much. Thank you, La Token VCTV, for such amazing shows and conducting them so well. The production quality and so much warmth. So thank you, Carol, Sunny, Amit. Thank you, everyone. Hasmik. Thanks to all of you. Have a good day ahead.
Have a good day to you, Tushar. Thank you. Bye.
Thanks.